Hello, I'm Aida with Premier Property Group, and I'm here with Patrick, and he's going to explain about the equity mover loan. So how you can buy a home, having your own home, and be able to use the equity and buy the new home. So he will explain it better than me.
Well, yes, my name is Patrick Lesire with Homebridge Financial, and on the Equity Mover program, it makes it possible, even when your home is on the market, to tap into the equity of the house and use that equity that you have at the house as down payment on the purchase of the new house. So, so the fact that the home is already listed is not an issue. Usually an equity mover loan, the bridge loan like we used to call in the olden days, is kept for a relatively short period of time. People keep for 60 to 90 days because their house is on the market but hasn't quite closed yet. So it's the beauty of making it possible to buy the next property without having to wait for the current house to sell. If your house is not yet on the market, then of course you can do a more traditional home equity loan and use the equity again as down payment on the new house as well. But the Equity Mover program is a wonderful tool. I just did one for a couple that is moving back to Belgium, my home country, and their home is important on the market, has not yet been sold, and they're using the Equity Mover as a down payment on the house that they're looking to acquire back in Belgium. So it's all a good thing.
Even for moving out of state?
Even for moving out of state, moving out of country, you just transfer those funds from your bank account here to a bank account back in Nebraska, for example.
Oh wow! So you don't handle the other side of the transaction?
I can, because we are licensed as a company to do business in all the states except for Utah. So we can handle the transaction on both sides as well if need be.
Oh, okay. So. Oh, nice. Very good.
Okay.
Okay. So I have a scenario that I want to ask. If I'm planning on selling my house.
Mm-hmm.
My house right now is shows that the worth is 450.
Mm-hmm.
So if I want to sell this house, so how much? Well, in the mortgage left right now is like 190.
Okay. So on the Equity Mover program, we have a limit currently of $300,000.
Okay.
So that's what you can tap into.
Okay.
On the equity, and that's for any loan basically, there is an income credit score, debt to income ratio requirement. So, but when all those little boxes check off fine, equity mover loans, they're closing in as fast as 5 days. Typically, it's a 10-day turn time, so it happens real quickly because most of it is done online to speed things up because time, of course, is of the essence.
Yes. So, but okay, I don't have the house listed yet.
If it's not listed yet, then typically you're better off doing a traditional home equity loan or home equity line, either one.
There is a difference.
There is a difference. A line is an adjustable interest rate. A loan is a fixed interest rate from day one. So if you take out a loan, then you start paying interest on that loan amount from day one. If you take out a line, then there is no interest due because you haven't used any of the monies. You only start paying interest once when you tap into that line of credit. So.
Okay.
Yeah.
Only okay. So, well, it's gonna be the other questions is how long do I have to sell the house after I get this?
I mean, the market is very busy, as you know. So there's no limit as to how long you need to keep the loan. There's no prepayment penalty. So. If you get an offer on a house tomorrow and the house sells in 2 weeks, that's fine. You pay off the line of credit, you pay off the equity mover loan, and we're going our merry way. So. Okay,
I want a little bit of time because I want to fix it after I move. I want to move out. I want to be able to fix it and have it ready to list.
Right.
So you said there is no.
There is no limit as to how long you need to keep the loan. So yeah.
Okay. So and then. So how am I gonna pay? I'm gonna pay my current mortgage.
Mm-hmm.
I'm gonna pay
the equity line.
the equity line, and then, I need to apply for another loan so I can buy the other house.
Right. So there is the possibility that people will have 3 mortgage payments.
Mhm.
The current house payment, the equity line, and then the mortgage on the new house. Okay, so when the current house sells, then the current mortgage is closed and paid
Mhm.
off,
The first one
the
is done.
line of equity is paid off,
Yes.
and you only have the 1 remaining mortgage payment. So,
Wow. So
Yeah.
how am I gonna qualify for all this?
income.
It's how much money?
Yeah.
Okay, let's see that I make $90,000 a year. Can I do this?
It depends. It depends on what you have for payments besides the mortgage. If you have like a card payment or
I have
credit
a card
cards or
payment.
student loans and so on, one would have to run the numbers completely to see, okay, based on your income of say 90,000, how much of a loan, how much of an equity loan can you qualify for? But to just say, hey, it's a blanket automatic, I need to run the numbers. I'm a stickler for numbers. I like the numbers to be right, and I
Okay.
don't want to get any surprises down the road.
Very good. So, but with my income, it is possible to
It's
get.
possible.
It is possible.
Everything is possible.
Oh.
It's
If I say maybe, well, okay. I was thinking because it depends how much money you make, if you're gonna be able to have 2 houses
Right,
in a line of credit.
right,
So,
right. Yeah, and it depends on how big of a mortgage the new house would be as well. See what that payment is all about. And,
yeah, I was thinking 660,000 because I want a little bit of land
Mhm.
and a big house.
Right.
It doesn't have to be new, but I want some land. So
Right.
that's what I was thinking.
Yeah. We
650.
definitely can run the numbers and see what's possible.
Good.
Yeah, yeah.
So how much credit do I need? Is my credit?
Ideally, on the credit score, you want to be at 740 or higher. And the reason being, in the eyes of Fannie Mae and Freddie Mac, a 740 credit score is someone that pays their bills on time. And in the world of mortgage pricing, that 740 is a big number. Because anything below that, then yes, they will still do the loan, but then there's a little bit of a difference in what it costs to get certain interest rates.
Okay.
So Fannie Mae, Freddie Mac are very much mindful of doing what they call risk-based pricing. So they're looking at your credit scores, they're looking at the debt-income ratio, they're looking at what you have left in reserves, meaning in various bank accounts, investments, so on, to determine what the ultimate interest rate is. And actually, talking about interest, there's about 30 different variables that come into play determining what somebody's interest rate is. So it's a bunch. So it's not a blanket. Hey, you're good for X% interest. We need to look at all the variables involved.
Okay.
Yeah.
But you still use whatever the current market for interest rate
Yeah.
right now.
Correct.
Okay. So what type of loan is this? Is it a conventional loan or what?
Conventional loan.
It's a conventional.
Correct. Yeah. And conventional typically means it's a Fannie Mae loan or a Freddie Mac loan. That's where we as lenders go to get the loan securitized. So we follow the guidelines from Fannie Mae and Freddie Mac to and underwrite the loan and approve the loan according to their guidelines.
So, are you guys gonna do an appraisal on?
It depends again as to how big the loan is. It depends on how much, it's on the new house. Okay? It depends on where the house is located, how much money we have down, what the credit scores are, what the debt to income ratio is. Have similar properties to the one that you're looking to buy, have those been sold in the recent time frame as well? And recently is typically within the last 90 days. So it's not an automatic yes, it's not an automatic no. One would need to look at the numbers again.
Okay. Yeah, because I wanna use the equity that I have in the house. I'm gonna move it all to the new house.
Right.
So, but I wanna make sure that I'm saying that it's 450,000. I wanna make sure that well, I think you're gonna make sure that that's what the
Yeah.
worth.
Yeah, and I apologize to you that for being a little bit vague, maybe even, but the world of lending, and I've been in this now for 28 years, the world of lending is that there was a time 12 years ago when lending guidelines were very lax, and that came with a very steep price and a very deep recession as well. So lending guidelines have tightened up quite a bit in that we want to make sure that when we make a loan, that it's not only economically beneficial for you as a client, but for us as a lender and for the community and for the investors in those loans as well. We don't want to go back to what happened 12 years ago and see people being hurt in any way, shape, or form. So, and that's kind of why I'm a little bit vague, because I need to put all the pieces of the puzzle together to arrive at a solution or a recommendation. So this is possible, or this, we gotta wait a little bit.
Well, sometimes we want something really vague, like, okay, I put this as a scenario, and many buyers do the same thing to me.
Right.
Okay, I like the house. How much money do I need to make to buy this house?
Right.
I don't know. Let me see.
Right.
How much are you making? How much is your debt?
Right.
How is your credit?
Right.
That's
And the challenge for you as a realtor and for us as a lender, ideally consumers come talk to us and get all of their ducks in a row when it comes to the financing. That way, when we can send you a pre-approval letter, we can tell, okay, this particular client is good for example, $300,000, and you can then show them different properties of the ones that they like in the neighborhood that they want to be in. Sometimes consumers get it backwards, and then we're behind, and we're struggling to get all the pieces together. So, but getting the finances done correctly up front, because it is a complicated process, is very beneficial for all parties involved.
Yes. Well, I do the same thing. I want to know first how much they are pre-approved for before I can do a search and tell you, okay, this is all these other houses available up to how much you are pre-approved, because why see houses when they don't know, and I don't know. Right. They like something, and what we're gonna do? We're gonna make an offer.
If they're looking at, for example, and they have their heart set at a $400,000 house, but then we get the financing later, and then they only can go up to $350,000, then there's broken feelings and hurt feelings, and that's not very good.
No.
We want to avoid that at all costs.
Yes.
Yeah.
We're gonna help people, not discourage people.
Correct. Correct.
Okay.
And like I've mentioned to you before, is that we have, as a realtor and as a lender, a huge responsibility towards people who are looking to buy a home, especially a first-time home buyer, because when they buy their first house, we now anchor them to a community, a city, a town, a school, a hospital, a church, recreation, and so on. So it's a big step for people to buy their first house. So we want to do it right from day one, because if we do it right, we're going to have repeat customers and referrals from that buyer down the road as well. And if I look at my personal business in 2021, 75% of my business was from past customers or referrals from past customers. So that's enjoyable for me.
Yeah, I have the same thing. When somebody refers me, somebody of their family, their friend, it's very rewarding.
Mm-hmm.
Yes. So, something else that you want to say about the loan, or something for the...
I would say when it comes to loans, let's have a conversation as to what is possible. The market is changing quite rapidly. Mortgage interest rates are changing rapidly. Underwriting guidelines are changing. Let's have a conversation and let's see what's possible today. And if it's not today, what is possible? What are the steps needed to, for example, work on a credit history to where you can buy in 3 months or 6 months or even a year down the road. Buying a home down the road, financially speaking, is a difference maker hugely. It's definitely a way to create financial independence and wealth and security as well. So
it is. Very
thank
good.
you.
I like it. Very good. Thank you.
Thank you.